Good morning, Bitcoiners. Hello, and welcome back to your Bitcoin economic calendar. I'm Mauricio Di Bartolomeo, co-founder of Leaden, and as with every Monday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, October 18th, and an action-packed week as always. In today's episode, we're going to start by looking at the Bitcoin Futures ETF in the United States, which was approved last week and is scheduled to start trading on Tuesday. We're going to break down how that could impact Bitcoin's prices in the near and medium term. We are also going to look at the Fed's decision to punt its tapering plans until after its November meeting and how that could be impacting equity markets and Bitcoin as well. We're also going to break down Bitcoin's massive 42% rally over the last 21 days. And we also have a very special announcement from Leaden. So grab your coffees. It's going to be a great one. Now, before we dive into this week's analysis, we are excited to introduce something new at Leaden. And that is that there is a fresh new way for clients to earn a reward by referring their family and friends to Leaden. And that has to do with the beautiful new referral dashboard that you have behind your screen. From now on, when somebody uses your referral link to create and fund a Ledn Savings Account, you and your friend will both earn 10 USDC automatically deposited into your savings account. Here are some of the benefits of our new referral program and some of the details that you need to keep in mind to earn the reward. So to highlight, rewards are now linked to assets deposited into Ledn's savings accounts. No loans are required anymore. Second, the minimum deposit requirement is only 75 USDC or 150,000 satoshis. That's 0.0015 BTC. This is the minimum balance which must remain in the account for 15 consecutive days in order to earn the reward. And last, but certainly not least, there is a new referral page, which is behind your dashboard or behind your screen right now, which lets you track the status of your various referrals, all while maintaining client privacy. And I'm just going to take you through that. It tracks your successful referrals, your earnings, and essentially lets you copy the code and share it in social. So you can check out the full details and of the program in the referral Q&A links, as well as the full terms and condition. Both of those links are in our blog of this issue, and you can essentially read through all of the details for the program. Now, starting as we usually do with Bitcoin, we see that Bitcoin had its highest weekly close ever last week, closing at $61,538, up 12.47% for the week. As we can see here, this was Bitcoin's third consecutive week of double-digit gains, and it capped a 42% rally over the last 3 weeks. We're just going to show here the little measurement bar that basically details how high Bitcoin has moved in the last 21 days, essentially. And we can see here that it's up or over 42%, 42.59%. So really great price action for Bitcoin over the last 3 weeks. From a technical standpoint, the only resistances left are basically at the 61,800 level, 61,700 level, which is bumping up against right now, and the all-time high of $64,895. On another positive note, the volume traded last week was slightly higher than the week prior, and that basically makes it so that there are 3 consecutive weeks of increasing volumes. This is typically a positive sign, although we may have some headwinds in terms of price due to market structure going into the week, and we're going to be breaking those down shortly. As highlighted last week, the first Bitcoin Futures ETF in the United States has now been approved by the SEC and is scheduled to start trading tomorrow. And that is the headline that's actually fresh from this morning from CNBC. The importance of this market event cannot be overstated, as it will make Bitcoin available to a brand new class of investors. How is this ETF different from the ETFs in Canada or the Grayscale Bitcoin Trust in the United States, you may ask? And that's a great question. The differences may appear to be small or subtle, but they are very meaningful from a market structure standpoint. We're gonna go through those. First, let's cover how it's different than the GBTC, which already trades in the United States. The GBTC is a close-ended fund. This means that the fund manager, Grayscale, can manage how many Bitcoins the fund holds and change the mechanism or timeline for investors to turn Bitcoin into units of the fund and vice versa. The Bitcoin futures ETFs are different in that as the ETF sees more demand, they create more units and purchase the underlying futures contracts. Conversely, if the units are being redeemed, the fund can choose to sell the underlying futures contracts. This means that the ETF can adapt and adjust to investor capacity faster than a closed-ended fund. This detail is very important as there are large investment funds that have strict mandates allowing them to invest only in ETF funds, such as the new Bitcoin futures ETF, and not in closed-ended funds like GBTC. Furthermore, these guidelines many times state that investable ETFs must trade in a particular venue, such as the NASDAQ or the New York Stock Exchange. This is the key difference between the new US ETF and the Canadian ETFs in terms of availability to new investors. These are the primary drivers of demand for the new US Bitcoin ETF, as it opens the door to investors that were previously blocked from participating given their investment mandates. So this does open up Bitcoin to a new spectrum of investors that previously could not touch some of the assets through which they needed to get exposure. And investors that were already able to purchase Bitcoin directly, or the futures contracts, or GBTC, or the Canadian ETFs, will not find net new value in their Bitcoin in the Bitcoin futures ETF, other than to potentially hedge or arbitrage between their existing positions or other instruments that track Bitcoin. This is because most commodity ETFs that are based on future contracts suffer from contango bleed, and we're going to get into that shortly. We covered this briefly last week, and this is really, again, we're going to break down this contango bleed issue, and this is really one of the main drivers as to why this new ETF may not be a net new tool for many people that could essentially otherwise purchase the underlying Bitcoin or the underlying futures contract without having to go through the ETF. But essentially, let's break that down one more time. Contango bleed is the issue that arises when a fund purchases overpriced futures contracts relative to the spot price of the commodity, and has that commodity then, that futures contract then expires at par because the commodity needs to be delivered on that date. And this is the case with Bitcoin. As you can see, and we've covered here many times, we show that the futures curves for Bitcoin tend to be basically pricing in price appreciation over time. So the fund basically has to overpay and have that asset convert at par, and then do it again and do it again. And essentially what happens is that the continuous overpayment of the contracts and the fact that these contracts expire at par causes the fund to underperform relative to the underlying spot asset. A great example of this, the best way to look at this is through an example. And in this graph here, which was shared by Ledn last week, we can see the relationship between the spot price of oil and the US oil ETF, which is basically makes it very clear. Essentially the orange line is the ETF, and the purple line is the spot price of the underlying crude that it tracks. So as you can see, while it does track it in some ways, over time, the fund tends to underperform the underlying asset. So in other words, futures-based ETFs are good at tracking short-term price moves of the underlying asset. However, their premium bleed means that they are not great instruments to invest with a long-term perspective. We'll cover more on this in our What's Ahead section later today. Moving over to our analysis of the S&P 500. Last week we saw that the Fed minutes, I'm just going to pop this article before we get into the chart. But last week we saw that on Wednesday, the Fed stated that it would not start the tapering process until after if its next FOMC meeting in November. And this was revealed in the meeting minutes that came out on Wednesday. And then the article behind your screen basically shows that headline. Many people were expecting the Fed to start tapering or announce tapering before the next meeting, which happens November 4th. The news of the Fed essentially deciding to punt the tapering until the next meeting created a short squeeze on Treasury bond yields and helped out the major US equity indexes to close out higher. And then let's go back to the chart so we can see this and compare it to the move in the yields. So last week, we said, as we mentioned, the S&P 500 closed higher by 1.92% at 4,474 points. Looking at the Dow Jones, we see that it also closed higher by 1.58% at 35,294 points. And the NASDAQ also finished the week higher, up 2.20% at 15,146 points. While the Fed minutes had the market cheering, and again, just to show you how the moves were in many ways connected to the news out of the Fed, look at the bars from Wednesday, Thursday, Friday. So the market essentially sold until the meeting minutes, and then the meeting minutes came out, confirmed the Fed is tapering, in at least one more month, and basically you see the market recover from that. We see similar things with the U.S. Treasury yields. Essentially, we see that they dropped tremendously when the Fed said that they were going to punt their tapering until basically after their November meeting. Now, again, just going back to this, while the Fed minutes had the market cheering, inflation data from later in the week gave Treasury yields a reality check. And as we covered last week, we saw a lot of inflation data out of the United States last week. And essentially the headline that you see here from the CBC, Canada CBC, reads that U.S. inflation rises to 13-year high of 5.4%. While equity indexes ended last week higher, increasing inflation, a tight U.S. labor market, and the Fed's tapering plans that are in place, just moved a little bit down the line, will continue to put downside pressure into U.S. equities in the near term. Last week, we saw inflation in the U.S. reach a 13-year high of 5.4%, as we see from the article. This is for the month of September. Now, while the rate of increase of inflation is slowing down, the absolute inflation rate continues to grind higher. The U.S. Producer Price Index, which is seen by many as a leading indicator to consumer prices, reached another record high last month of 8.6%. And here's the headline around that from Al Jazeera. Now, to essentially illustrate the relationship between consumer price indexes and producer price indexes, we thought this chart was very insightful to share, as it shows the relationship between the two very elegantly. And this was shared by Ledn Announcement last week. So as you can see, producer prices tend to lead consumer prices higher, and producer prices right now are sitting quite higher than consumer prices. So here, if we look at these trends, it would look as consumer prices are going to be under pressure to the upside to match the pressure that producers are seeing. They will basically adjust their pricing and pass them through to the consumer. Now, inflation right now, the signs are not just limited to the United States. We continue to see essentially shoots from China to Europe as nations are scrambling to deal with rising energy prices. As you can see, this is an article that says that from last week, China coal reaches record highs, and they're now expecting a winter chill, which adds to some of the concerns. This is very relevant for future inflation estimates, as energy prices affect basically every single supply chain and product. Producers will likely continue to pass these higher costs along to the consumers. In China, rising energy prices present an additional issue as the Chinese government fixes the prices that utilities can charge consumers for energy. This means that one way or another, the Chinese state will have to eat the losses. They either the utility eats the losses, or the Chinese government eats the losses, or they'll have to pass on those higher energy prices to the Chinese consumer. That neither of those options are good for the Chinese economy. And as a last canary in the coal mine for future inflation, data from the US labor market suggests that in the month of August, we saw one of the largest waves of employees quitting that we have seen in recent times. And some publications have referred to this as the Great Resignation that we're seeing in the United States. If our assumptions are correct, this could mean that employees are flexing their muscles in a tight labor market to get better conditions and higher salaries. Both could lead to even higher inflationary pressures in the future. So, more on this in our What's Ahead section. Moving over to our analysis of gold prices, we see that gold was able to eke an increase, essentially closing last week higher by 56 base points at $1,776 or $1,766 per ounce. This was largely on the back of lower treasury yields, a high inflation reading, and a weaker dollar index. We're going to break those down shortly. But as we covered above, the yields on U.S. treasuries dropped as the Fed meeting minutes revealed that it will not start tapering until after its next meeting on November 4th. Many investors that were positioned for a taper announcement before the next meeting had to cover their shorts, essentially. And they went and bought 10-year and 30-year bonds, making their implied yields drop. The yield on the 10-year note, and we're just going to pop these just so you see, this is the weekly move. So the yield on the 10-year note last week dropped by 1.68%. And if we see the yield on the 30-year note, it also dropped by a whopping 5.13%. Looking at the US dollar index, we see that it also finished last week slightly lower by 16 base points. And we know that this tends to act as a tailwind for most commodities. Checking in on oil's relentless ascent, we see that last week oil closed the week higher as well, 3.73% higher at a price of 82.47. It seems to be running a little bit higher this morning as well. And again, this further accelerates the energy price inflation narrative as we see, oil essentially has been rising since August 23rd. It has not a single down week since the end of August. Separately, there was an interesting article from Barron's over the weekend that essentially, the most important thing about this article is that it had a very, very interesting subheading, which is that the subheading reads, "Gold may have been replaced, at least temporarily, by Bitcoin as an inflation hedge," end quote. I believe this is the first time that a mainstream media publication refers to the replacement of gold with Bitcoin as an event that is already happening, and it no longer refers to this as an if Bitcoin replaces gold as an inflation hedge. This is actually being written in the present or past tense, which basically makes the case for this narrative to be very much a part of mainstream narrative right now. We should also add, and again, just talking about the headline only, we should also add that the current macroeconomic backdrop is not favorable for gold. Gold prices are inversely related to the real return of US Treasury bonds. And the real return of those bonds is essentially the yield on those bonds minus the inflation rate. As interest rates are set to rise, this will put continued pressure on gold at least until mid-2022, which is essentially when the Fed says that it should stop its tapering process. So, interesting times for gold, and more on this in our What's Ahead section. Moving over to our analysis of DeFi, we see that the DeFi index and Ethereum continue to underperform Bitcoin in the recent weeks. The DeFi index finished last week up higher by 7.23%, while Ethereum finished last week higher by 12.36%. So a similar rise than Bitcoin, but slightly lower. Bitcoin leading the way may be attributed to the excitement around the Bitcoin Futures ETF that was recently approved. However, DeFi tokens appear to still be dealing with the hangover of Compound's $160 million bug event. This publication last week essentially states that the bug was patched unanimously, yet the price of Comp, if we look at that token in particular, basically finished last week barely higher, 2.32%, when everything else was soaring, and is already down this morning, again, down 2.3%. That token is currently sitting at around $303 in price. Now, while the total value locked in DeFi protocols seems to be approaching all-time highs, the protocol tokens don't seem to be anywhere near that. This could mean that the total value locked of these protocols are rising mostly because the value of the Bitcoin and Ethereum collateral that is sitting in these protocols is rising. While at the same time, investors may be just selling all of the reward tokens that they're getting and keeping hard assets as collateral locked up in these contracts or in these protocols. Checking in on stablecoins, we also see that while there are headlines around potential regulation of stablecoins in the US, and that has been circulating for a few weeks, this has not stopped the astronomical growth of the circulating supply of USDC. This circulating supply has grown from 27 billion in September to the current 33 billion, and that is a growth of 22% in 6 weeks. So there is definitely not any loss of steam in that trend. Moving over to our Bitcoin mining difficulty commentary, not much has changed on this front since last week. The next difficulty adjustment is scheduled for this evening and should bring difficulty higher by 0.97% to 20 terahashes. There have been some interesting articles over the last few days, and this is one we wanted to highlight. So there was an article last week that basically shows that the geographic location of miners has shifted since the China ban. And what that has led to is, I'm just going to show the graph just so that you see, because it's quite interesting. So this is the graph that shows the global share of Bitcoin hash rate. And as you can see from the graph, the United States has grown to become the largest contributor to global hash rate at 35.4% contribution. The second place goes to Kazakhstan, third place Russia, and the fourth place is our hometown, Canada. For context, China made up around 75% of the global hash rate as of September 2019. The dimensions of this shift are unprecedented in Bitcoin mining. There have been no major changes in the mempool this week. Transaction costs and times continue to be quite reasonable. So it's a really good time, continues to be a good time to transact on chain. And as always, we leave you with what's ahead for the week. While there's been a lot of excitement around the Bitcoin ETF announcement, it is important to remember the old Wall Street saying, buy the rumor, sell the news. The Bitcoin ETF is a very important announcement for Bitcoin, and rightfully, many will believe that this is a good omen for its long-term price appreciation potential. Once the fund starts trading this week, many will hear about Bitcoin for the first time, and a new wave of retail and institutional money could enter the space. Some institutions may be banking on this. Institutions could have purchased Bitcoin weeks or months ago in anticipation of this event. They may also be planning to take some profits once the event materializes. This could put downward pressure on prices. And for this, we wanted to share a graph that we think is very insightful. And this is courtesy of Frank Chaparro at The Block. And this chart highlights that exchange volume, so retail exchange volume, which is mostly individuals, was skewed to the sell side 2 weeks ago. Whereas over-the-counter volumes, which are mostly institutional, were skewed to the buy side. If institutions look to unload some of their positions and retail or new institutions don't show up to buy them, this could put pressure on Bitcoin prices to the downside for the week ahead. Now, if the wave of new demand overwhelms the sellers, then the market could move higher. As always, we wrap up with a summary of upcoming economic data and earnings reports that are coming out this week. So on Tuesday, it's actually a light week of economic data out of the United States. On Thursday at 8:30 a.m. Eastern, we get existing home sales in the United States. The expectation here is for 5.88 million home sales. But the key thing to watch here will be the magnitude and the speed of price appreciation in homes. As a refresher, the prices of US homes were up 18% year over year in August. So many will be looking at whether that pace of acceleration continues or especially starts to hit a peak. So we've covered a lot today. It's going to be a very exciting week ahead. If you have any questions or comments or suggestions, we welcome you to drop them in the comments. If you enjoyed the show, if you learned something today, we welcome you to like it and subscribe to our channel. And if you don't yet have a Ledn account, we welcome you to check out ledn.io and start earning the best interest rates for your USDC and your Bitcoin. And check out our new referral program. Go refer your friends and family so you can all earn $10 while getting the best interest rates on your favorite assets. We also have the best rates on Bitcoin backed loans if you need cash and don't want to sell your stack. So have a great week, everybody. See you next time.